Um, like Roshan mentioned, here with me today we've got Maximilian, Koeswoyo, Ambrish, Shah, and Zane, and we'll just be sharing a little bit more about the US market, specifically in the tech sector. We'll have some, some macro themes, some sector themes, followed by a small technical analysis session. Please feel free to put your questions in the Q&A tab, and we'll get to it once the presentation is over. So with that, let's just begin. Just a brief disclaimer. Okay, so like I mentioned earlier, just some content for today. We'll be going through the first quarter's performance of this year, some macro themes that we're seeing right now, a few sector themes, and we'll be running through some of our stock picks, followed by the technical analysis and then the conclusion. So let's just dive into the first quarter's performance. The first quarter was actually really positive for I guess the equity markets. The NASDAQ actually outperformed. That was up 21% for the quarter. The S&P, however, was up only 7%. Several reasons why the NASDAQ outperformed in our view. Firstly, there was a bunch of cost-cutting initiatives across the tech companies, so they were laying off a lot of employees. And I guess the market really received this well. I guess because of the implied expansion in margins for this year, as a lot of these companies, cut off the fat and become a bit more cost efficient. Secondly, there's also a large influx into AI-related companies, so companies like NVIDIA, AMD, even Intel. And thirdly, there's a weaker US dollar, or rather the dollar weakened throughout most of the first quarter, which is also why gold was up 8% as well. Gold is also up mainly because of falling treasury. Surprisingly, commodities actually declined almost 7%. It's quite unusual because it usually rises in tandem with risk on assets. Also, a side note, the best performing, I guess, asset class for the first quarter was Bitcoin. It was up about 70% year to date. So when we dive into like the sectors, the individual sectors, growth stocks actually performed the best in the first quarter, and this was led by semiconductors. They were up about 30% year to date. You have here, semicons, technology, communications, which is mainly, I guess, your technology companies like Alphabet, Netflix, Meta, as well as consumer discretionary companies. The laggards were your defensives, your utilities, and healthcare and consumer staples. And then last year's winner, energy, came in second to last. Obviously, the main loser was already the main underperformer for the quarter was financials, especially with all the uncertainty surrounding Silicon Valley Bank crisis and all that. So financials performed really the worst out of the lot. Moving on to the macro themes, there are several themes that we're seeing. The first is that we expect inflation to fall quicker. Over here, there's a chart on your, I guess, your PCE, which is inflation, and in comparison, there's a chart on services inflation. And so you're seeing right here that actually headline inflation, which is PCE, actually dropped from 7% to 5%, whereas services has actually continued to climb above headline inflation numbers to about 5.7%. Inflation seems to be trending downwards, which is a good thing. Goods inflation has really collapsed quite significantly. However, because services has kept on climbing up, it's really held up inflation from falling faster than it should fall. The downside with this is that the data usually lags real-time data, which we see as falling quite rapidly, and we'll show this in the next couple of charts. So this is a chart of the rental index and the housing inflation. Right now, the housing inflation is the orange line, and the rental index is in blue. As you can see, over the last year, actually, rental prices have collapsed quite significantly. However, hasn't really been reflected in housing inflation. Um, and so we do think that, I mean, looking at this chart, we do think that housing looks to have peaked quite significantly, and so we would expect housing inflation to actually start coming down. When you look at housing inflation right now, it looks to be plateauing a little bit, and we think that once it starts turning downwards, that's really it'll really go on a lot quicker than how it's been going up. Likewise is the Baltic Freight Index. You can see here freight rates are already almost back to pre-pandemic levels, and this is a good indication of goods inflation because a lot of the supply chain issues have been easing. It's a lot easier to get your Lazada, Amazon products, and so this is a good indicator that half of the inflation battle is won. We're just waiting for services to come back down and for overall inflation to come back down to a little bit more normalized level rather than it's 4-5% right now. Second theme we are seeing is we expect the Fed is nearing the end of its rate hike journey. When you look at the Fed funds rate right now, it's about 4.8%. It's actually gone above core PCE, which is the main indicator that the Fed looks at when it looks at inflation. And usually the tendency is that once the Fed funds rate goes above inflation, it doesn't really tend to go a lot higher. It kind of just stays above until inflation actually starts falling down. In which case, after that, then they'll start. The Fed will actually start cutting rates. Just another chart here. We're trying to see whether there's a correlation in the US 2-year and Fed funds rate. You can see quite clearly the last 3 times the US 2-year actually dropped below the Fed funds rate. That's when the federal funds rate actually started to plateau. But the thing is, the rates tend to flatten and stay there for around 6 to 9 months once the 2-year kind of goes below it. So this whole idea that the Fed will be cutting rates, and it's what the market's actually pricing in, may not really be what is going to happen, just based off history. Moving into the Fed funds futures expectation, and this is essentially what the market expects the Fed to do. When you look at this chart over here, there are 3 main lines. The first is pre-SVB. Market was pricing in rates to hit about 5.6% for the year, and to finish the year about 5.5%. And then you've got post SVB where expectations really fell through the roof. Expected a lot of more cuts. And then the blue line, which is what we're looking at right now, is post FOMC. Rates have come up a little bit. The market expects the Fed futures to hit about almost 5%, indicating a slight increase in the next FOMC meeting, followed by a pause, and then 4 cuts to end the year at about 4.3%. So our next theme is recession is near, and we believe that just mainly based on the bond market pricing a recession, we do think that once, and this is the yield curve spread between the 10-year and the 2-year. You can see for the last 2 times in the red circles there, once this yield spread actually starts going back above 0, that's usually when a recession occurs. So actually, I guess for right now, we're still waiting for this to happen, and for a potential recession to take place. Just a chart on US manufacturing PMI. It just shows that manufacturing has actually been contracting quite significantly for the past year. Usually, once this PMI drops to, goes into a deep retracement below 50, usually below 45, that's usually when recessions are called, or market actually goes into a recession. So for right now, it's still not quite there, but it's just something to note. So over here, we've got a chart that is, I guess, a little bit more relevant now, especially with the whole SVB crisis. You can see this is in the blue line here. It's I guess, the percentage of banks tightening their lending standards. So it's basically a poll of a lot of your banking managers to see how strict they are with lending out loans, with giving out loans, and then the line in orange is commercial loans growth year on year. And you can see that there's kind of a correlation whenever banks start to tighten their lending policies and make it a little bit more difficult to lend. Loans growth actually starts to contract, and this is actually what we're seeing on the right hand side right here. The banks, and this is actually pre-SVB, so you expect that this number actually would shoot up quite a fair bit, and for the orange line to come down quite significantly. Usually, once banks start tightening, it signals a recession. It eventually is quite it is going to happen, and you can see that in the shaded portions over here. So just this, I think this is my last slide on recession. It's just the Fed funds rate versus the S&P 500. So the S&P 500 is in orange and the Fed funds rate is in blue. Usually what happens when the Fed starts to actually pivot is that you actually see the market start going downhill. And there are several reasons for this, and this is the chart since '99. So you've got the tech, the dot-com bubble, the GFC, and then the COVID crisis. So a lot of times, what happens when the Fed starts cutting rates? They usually break something in the system, which leads to a recession, and then the market starts freaking out, which is why there's such a strong correlation to that. So for our fourth macro theme that we're seeing, we continue to see earnings headwinds persisting. And this is a big headwind for the overall equity market. We can just see here, loans growth for the S&P 500. Oh, sorry, earnings growth for the S&P 500. Every time it's gone negative. Right now, based on the chart, it's hovering about 5% year on year. Usually, once it goes negative, we do start to see the equity markets fall in line with it. And so the trend right now is that earnings probably might not go that negative, but to remain relatively flat year on year for at least the next few quarters. That's the I guess a lot of estimates is the consensus estimates from a lot of analysts, and it's also something that we're seeing from a lot of companies when they come out to issue their earnings calls. When we look at the NASDAQ, which is mainly your tech guys, the big tech companies, so when we look at the NASDAQ, the forward PE, it still looks relatively expensive. It's about one standard deviation away from its 15-year average of 20 times. So right now it's trading about 26 times. And generally, what you want to see from this chart is when you look at buying opportunities, is you want to see the forward PE kind of drop a little bit more away from its average, so closer towards the green line instead of the red line. That basically means that if it's towards the green line, it means that stocks, or at least the NASDAQ, looks very undervalued compared to what it's actually earning. But this is not the case that we're seeing right now. At the same time, this is a NASDAQ earnings yield, which is basically your inverse of the PE ratio versus the 10-year yield spread. So you're taking the inverse of the PE ratio of the NASDAQ, minusing off the US 10-year yield. And what you can see right now from this chart is that it's almost at parity, or rather it's actually slightly below parity compared to the US 10-year. And what this means is that essentially if I were an investor, I could go out and get a US 10-year. Right now I believe is about 4% or slightly under 4%. And I could get this yield risk-free pretty much. Whereas if I were to put my money into the NASDAQ right now, I'll be getting the same yield but with a lot more risk. So when you compare just both asset classes, it does seem a little bit more attractive to go into fixed income rather than to put it in the equity market. Moving to the sector trends, there are a couple of sector trends that we want to highlight. The first is that we actually, we're seeing tech layoffs start to pile up. So this is a chart of tech layoffs in I guess in the first quarter of 2023 all the way back to the first quarter of 2020, which is right before COVID. When you're seeing the biggest thing that stands out right here is, there are about 155,000 layoffs already in the tech sector for the first quarter of this year. That's almost the same amount as total layoffs for 2022. And we think that obviously, some of the reasons for this is because operating margins have been dropping quite significantly, and operating margins right here is we just took the biggest tech company, which is the Fang M. And so their operating margins for the last 12 months have been dropping from about 25% all the way down to 20%. And this is cost cuts are a way of layoffs are a way of cutting a lot of costs in a lot of margins for all these companies. And we do think that when you take a look at a company like Meta, they laid off about half of their employees that they actually hired through the pandemic. So since 2020, they hired about 40,000 employees. Over the last 6 months, they've laid off about 20,000 plus. So we do still think that there is some more room to for layoffs to come, although we don't think they'll be as drastic as what happened in the first quarter of this year. So our second theme that we're seeing is AI. AI has been quite a hot topic lately. And we do see that the AI boom is well on its way. When you look at this chart, you can just see this massive trend of global corporate investment that has been pouring into AI. So this number has grown over the last 3 years, up until 2021. So it's seen quite significant growth. A lot of these have come through either private investments or M&A work. And so we could see exponential growth for 2022 as well. For 2022 and 2023 as well. And this mainly is because AI technology has advanced quite a bit. We've moved away from traditional AI to this thing called generative AI. The traditional AI is quite predictive in nature, so it works based on recognizing patterns from existing data, whereas generative AI which is the new type of AI right now. It produces new data based on the underlying. So it's a little bit more perceptive in how it works. It's a little bit more advanced and has a lot more use cases. When you look at something like ChatGPT, which is a large learning language model, in a way it's I guess it's a text-based generative AI framework. And when you look at the app itself, it's the fastest app to surpass 100 million users. And they did this in like 2 months. When you look at other really big apps like TikTok and Instagram, TikTok took about 9 months to hit 100 million users. Instagram took like almost 3 years. And so you can see that I guess this trend of generative AI is here to stay, at least for now. And we do expect the next wave of AI inventions, AI capabilities to be driven quite significantly from SaaS companies, so software as a service companies. These companies have been using BI technology, which is a lot less capable than generative AI. When you think about SaaS companies, you think about companies like Salesforce, you think about companies like Adobe, maybe even some software developers or game developers like Unity Software. They'd be able to leverage on some of these new AI technologies to drive better user experiences, or just drive better integration with their platforms. In terms of digital ads, they'll also be able to leverage on generative AI. So for example, right now, if you're looking at if you're scrolling through Instagram or Facebook, you get an ad. The ads that are shown to you, the technology behind it, the company behind it, so Meta or whoever, they'd be able to show better ads that are a bit more informative, a bit more relatable to what the customer or what the user is actually wanting to see. And then of course you've got your semiconductors, which stand to benefit the most from AI, because of the suppliers of the hardware that AI runs on, which is mainly a GPU. So when you talk about semiconductors, obviously the biggest name you think about would be NVIDIA, and to I guess a smaller extent AMD. Yeah, but the boom in AI generally should benefit all the way from the infrastructure layer, all the way up to the application layer of technologies, and something that is very interesting to see, and it's quite exciting to look forward to. Moving into our next sector theme, we look at streaming, and we still think that streaming is remaining fairly resilient. When you look at some of its trends, it continues to gain popularity in the first quarter of this year. Streaming is the blue line, and then you've got cable TV, which is the orange line, and then broadcast TV, which is the red line. There has been actually a sharp drop from November to December for streaming. The main reason for this is a reclassification of I guess how they actually quantify streaming. So there's a recategorization of VMPVD, which is virtual multi-channel video programming distributors. So you think about like Hulu Live and YouTube Live TV. And so it's really just a recategorization. But when you look at the whole trend, it still is trending upwards, and we do expect this to continue moving forward, especially with when you look at streaming as from a price point perspective, like $15 or so, it's a lot cheaper than subscribing to cable, and the whole industry of the quality content that you're getting right now is improving day after day. Streaming players like Disney and Netflix are putting more and more money into producing content that people actually want to watch, and so that's something that's really driving the whole streaming wave. Besides the fact that you can watch it anytime, anywhere on demand, rather than sitting down at a TV at a specific time to watch your show. So that's all for my portion. I'll hand it over to Max to move on with Semicons. Thanks.
Yeah, thanks, Jonathan. Good evening, everyone. So apologies. Apologies for that. So yeah, I'll be giving a brief update on what is happening in the semiconductor industry. And as you can tell from the title, semiconductor the growth in semiconductor is still experiencing contraction. So this chart is from ECIA, which is the Electronic Components Industry Association, and we would like to note that this, although it says quarter-over-quarter growth, it is actually plotting the year-on-year growth of the trailing 3-month sales in any trailing 3-month semiconductor sales in any given month. So yeah, from this chart, there are two key messages that we would like to get across. Firstly is that the semicon industry is highly cyclical, and the industry has gone past several cycles over the past few decades. And we can take a look at this as well, that each cycle lasts for about 3 to 4 years, or about 48 months. And the length of each cycle is measured as the duration between the start of the upward trend of each cycle and the bottom or the trough of each of the industry cycle. So for the current cycle that we are in, we can see that it has actually started since the mid of 2019, where it started when the line starts to go on an upward trajectory. And we are currently in the downward trend of the semiconductor industry, which really took into full effect in the middle of last year, when the demand for electronic goods started to decline. So, and this brings me to my second point. So secondly is that we can see that the decline in semicon revenue is mainly dragged down by the significant steep decline in memory prices. So if we take a look at the orange line, we can see that the trailing 3 months memory sales in the December 2022 has fallen by almost about 50%, whereas the other semicon revenue, which is any semicon aside from memory, has actually declined quite marginally by at about 2 to 3%. And therefore, if we combine all of this together, this results in the blue line, which shows us that at the end of 2022, the semicon sales has actually declined by about 14%. So we can see that the impact of the memory decline is quite significant for the industry, and this is not surprising because memory makes up about 25% of the overall industry revenue. So yeah, in short, this is the message that we want to get across, which is the memory is the main laggers in the industry. So yeah, that's for me. I'll hand over my time to Ambrish to talk about cloud.
Thank you, Max. So next slide, please. Our next sector piece, which is cloud. So basically, cloud computing, just for the information to those who don't know, cloud, it basically means that you can store and access the data across the globe over the internet. So you don't need to store that particular data on your local computer, and instead you can just rent a space from the cloud service providers. So for your Google Drive or Microsoft OneDrive, they are the examples of cloud computing services. So the cloud revenues, the cloud revenues, top three leading players are Amazon, Microsoft, and Google. So just for example, Netflix, it heavily relies on the cloud services that are offered by Amazon. So the content, its content, they are stored on the Amazon's web service, the data centers, and they don't invest in their own infrastructure data centers. So as a result, they are saving a lot of money and low maintenance cost as well. And it also helps to improve the collaboration, and also there are the other benefit that it could be accessible from anywhere. So for public cloud revenues, it's expected to grow by about 19% CAGR over the next 3 months. And the main growth drivers for this particular sector are the digital transformation trends as the companies that digitize their operations, as well as it could also get a boost from the breakthroughs through the artificial intelligence segment. So that's all for cloud. I would now like to pass on to John for individual stock picks.
Thanks, Ambrish. Okay, so I guess we'll move into the stock picks now. Talk specifically about the big tech guys first, the FANGMs. When you look at this price to sales chart, I guess right now FANGM is trading at about 7 times price to sales, so it is slightly above its long-term average of 6 times. The interesting thing is that when you compare it to this whole period from 2014 to 2020, growth was about twice as much as what it is right now. It's in the mid-teens, high teens. Right now, growth is about 5 to 7% year on year. And so, from a price to sales chart, we do think there is, I guess, a limited upside. But the good news is that a lot of these big tech companies, they've kind of gone out of their hyper growth stages and then moving it a lot into being a bit more efficient as a company. And that's why when we look at the next chart, which is on price to earnings, forward price to earnings, we can see that in this red circle over here, the forward price to earnings is around about 27 times, which is about 1 standard deviation below its average of 32 times. So still relatively high compared to, I guess, the overall S&P 500. But when you compare it to just the FANGMs, it right now seems like a relatively attractive area to kind of pick it up. You did see quite a sharp rebound actually. The forward PE ratio was about 25 times, and but shot up to about 27 times, and mainly due to a quite significant jump in the stock price of many of the FANGM companies over the last quarter. So diving into the individual companies, we'll start first with Alphabet. And our title for Alphabet is Recovery in Margins. You can see there's a sharp drop-off in margins from 2021 to 2022, so about 30% to about 21%. So essentially it's cut in half. The main reasons for this think we all know, was a very big slowdown in the digital advertising industry. And so revenue really slowed quite significantly, whereas expenses, remain relatively high. We still do expect revenues to grow about 8 to 9% for this year. And that leads me to my three main points. Alphabet still has very resilient growth in it in terms of revenue. They also have very strong user engagement for their YouTube Shorts platform, which is their short form video platform. So right now, this platform is seeing more than 50 billion daily views. The near-term downside for Shorts is that it doesn't actually monetize as well as its other, I guess like regular video and print ads. And so when you see users spend incremental time on Shorts, you're kind of taking away time from its other platforms like your normal YouTube and stuff like that. And so in the near term, this actually decreases revenue growth because you're basically taking market share and taking revenue from other segments. But in the long term, as short form video starts to monetize a little bit better, then this should really take off moving forward. The second point is that we expect margins to recover. I guess one of the main reasons during the earnings call for the fourth quarter, they did mention that they do expect a lot of the expenses to be in line with 2022. So the expenses for this year to be in line with 2022. So not much growth in terms of expenses. And obviously when your expenses don't really grow that much, but revenue grows a bit, then you start to see a little bit more margin expansion on the bottom line. We do expect this to be a little bit slow because when you consolidate and when you lay off employees, there are always these severance related charges and consolidation charges that you have to take into consideration. The company also generates very strong free cash flow. It generated about 60 billion free cash flow in 2022. We do expect this to increase to about 75 billion this year, especially as they don't spend so much on capex. And they're able to use this money and maybe return value through share buybacks to its investors. The last point on valuations is that we think that valuations remain fairly attractive for Alphabet. Right now, it's trading around 18 times for PE, almost one standard deviation below its long-term average. So when you look at Alphabet as a whole, it's going through quite a severe downturn along with other digital advertising companies. But we do see that recovery, or at least the company is going to be a little bit, once it starts being a little bit more prudent in its spending, it manages its margins a little bit better, and the digital advertising industry starts to recover, then you definitely see quite a significant benefit from these two kind of factors. But not forgetting that Google, I guess, is still the dominant player in digital in search advertising as well as web browsers and mobile operating systems. So moving into our next counter here. Yeah, so moving to our next counter here on Meta. We have a titled Year of Efficiency, and that's mainly the theme that they're going to have over for 2023 and 2024. Right here, this is a chart of year-on-year headcount growth versus revenue growth. So you can see the headcount numbers at the end of last year was about 86,000. It was a slight decrease compared to the third quarter of 2022, and that's because they announced some major layoffs in the fourth quarter, and they also announced more layoffs in the first quarter of this year. Obviously, reasons for the layoffs is that margins are actually decreasing. Net margins for 2022 were about 20%, and this was down quite significantly from about 30-ish%. From 30+% when you do a trailing 12 months net margins. Of course, revenue growth has decelerated quite significantly, and which is one of the reasons why, like Alphabet, they're in the same boat in the digital advertising industry. They've kind of focused on improving their efficiency, laying off a lot of workers, and trimming a lot of fat off their company. So the second point that we have for Meta is that even though they are laying off a lot of workers and improving their efficiencies, we do expect there to be quite a significant lag in margin recovery, at least for 2023. So we'll see a little bit more recovery in 2024. Like I mentioned earlier, a lot of it is because, specifically for Meta, they've got a lot more multi-year investment commitments in R&D, their metaverse, in revamping their platform. And so a lot of these expenses are actually very difficult to cut off. At the same time, in the fourth quarter of last year, they actually had to deal with a $4 billion restructuring charge. So you can imagine if they continue restructuring in the first quarter, they probably would expect something similar, and if they keep doing that, if they keep downsizing, they just keep paying a lot of these charges, which eats into their margins. And lastly, like I just alluded to, digital advertising headwinds in the near term, are still there, and this really places quite a significant headwind on Meta, because that's really its main source of revenue generation, and they have fairly limited products like Instagram and WhatsApp, and there's also a lot of competition from TikTok as well as YouTube Shorts. So moving into our next company, which is Netflix. For Netflix, this chart is ARM, which is their average prices. You can see, ARM has been trending upwards, over the last few years, and the line in orange is actually the operating margins that have been decreasing. So one of the reasons why operating margin has been decreasing is because companies actually been investing quite heavily in their own original content production. Previously, they used to spend a lot of money on licensing production, licensing a lot of films from like HBO and Disney. But lately, they've been kind of taking it into their own hands and ramping up their own original productions content, so that they can be a little bit more self-sustaining, especially because Disney and HBO are actually their competitors. So it doesn't really make sense to keep licensing it from them when they can make it on their own. So for Netflix, our title is the next wave up, because we do think that margin expansion is on the horizon. You couple that with prices, average prices that have continued to go up. It's a recipe for success. In terms of our three main points for Netflix, the first is that Netflix's subscriber base has continued to expand year on year. So Netflix had about 231 million subscribers at the end of last year, and this was an increase of about 4% year on year. They added about 9 million subscribers for the full year, most of which came in the fourth quarter alone, about 7.7, so close to 8 million. 90% of it came from the fourth quarter. This is actually quite significant because they saw quite a lot of subscriber losses from the Russia-Ukraine war, especially because I believe they were kicked out of Russia, and then obviously displacement of people in Ukraine. They didn't really have access to the Netflix and all that. So it really just is a testament to the quality content that Netflix is actually producing, and it's able to attract more new users with the shows that it produces. Its original production shows regularly fill the top 10 weekly streaming charts. I believe like 5 or 6, so more than half of the top 10 streaming productions are actually from Netflix, both for series as well as films. The second point we want to touch on is margin expansion, and this we expect to come from its new ad-supported plan that has been doing fairly well. When it comes to ad-supported, ad revenue is a lot higher margin, usually gross margin of 80-90%. And so if and when they can really bring this plan to scale, get a lot of users on that, leverage the power of digital advertising. Obviously, once digital advertising is actually starts to pick up again, then we should be able to see quite significant margin expansion on the horizon. The company also is cracking down quite heavily on password sharing. So we do think that once they kick off a lot of the freeloaders that share passwords outside of a single household, a lot of them, there's still this value proposition that a portion of them will maybe sign on as new users, maybe they won't go for the full basic plan. They'll maybe go for the cheaper basic ad-supported plan, which is roughly about half the price. So instead of $12, it's about $6, $7. And lastly, they continue to ride tailwinds from the ever-expanding streaming market, especially since they are the leader in streaming. They're way ahead of Disney when it comes to content production and monetizing its users. So both of these two largest players, and I guess with YouTube as well, they stand to benefit the most from streaming gaining popularity. So that's all for my topics. I'll hand it back over to Max and Ambrish to carry on with the rest. Thank you.
Thanks, Jonathan. I'll start off with Apple, and the title is Bright Side on Services, and I'll get back to you on that later on. So the first points on Apple, the first positive for Apple is that its iPhone managed to increase its market share in the fourth quarter of 2022 with about 25% market share. And sorry, and this was possible because the iPhone managed to gain some market share off from Samsung, which declined, which was the leader then. And then we also think that this is the increase, and the increase is also because customers in emerging countries there's increasing number of customers in emerging countries that decides to buy an iPhone instead of buying other cheaper Android alternatives. And this is actually backed, and this is actually backed by Apple themselves during their latest earnings call, whereby they say that the company has been consistently experiencing and has been consistently enjoying strong double-digit growth from emerging markets, especially in countries like India, Mexico, as well as Vietnam. Yeah. Then for the second point for Apple is that we think that the bright side for Apple is that its services segment is still continuing on its growth, and we think that this is very beneficial for the company because firstly, services will bring in natural recurring revenue recurring nature in revenue, and then services is also a much higher margin business for Apple. So we think that by having this, so we think that if the services revenue increase, any increase in the segment revenue will also traverse down to the bottom line and increase the net income as well. Then, however, for the near-term headwind for Apple, is that it seems like the demand for smartphone is continuing its decline. And IDC has recently announced that it expects the total global smartphone shipment to decline by 1% in 2023. So yeah, this will inevitably affect Apple. But I guess the silver lining from that expectations is that the decline in Apple's shipment, the decline in iPhone shipment, is expected to not be as severe as what their Android counterparts is going to experience. So yeah, so for the two main thesis for Apple is that firstly we like their services because as I mentioned just now, and they are higher margin business, and they are actually increasing their revenue contribution, as you can see from the blue bar at the bottom of the chart. They are increasing in percentage of the overall revenue for Apple. And then secondly is that Apple enjoys a strong customer brand loyalty. Which means that if any consumers decided to put off their iPhone purchase this year, there's a high chance that they're going to do it in the next financial year, which is when Apple released their iPhone 15 supposedly in September. So these consumers will not just simply buy an Android smartphone that can last them for years. They will rather wait for the next iPhone release to make that purchase. Yeah. So that's for Apple. Now moving on to Amazon. So for Amazon, the story is still the same, whereby the company is still emphasizing on increasing its efficiency. Amazon. So for the first point, Amazon has embarked on an aggressive cost-cutting measures, which ultimately led to the layoff of 27,000 employees. And this initiative has actually bears its fruit. As we can see that the average revenue per employee is about 13% in the fourth quarter of 2022, is about 13% higher than that of the fourth quarter of 2021. And we expect that if Amazon decides to hold their employee count at this level, based on our projections for FY23, there's a chance that the average revenue per employee is going to increase by 10% year on year. And then furthermore, in the month of February, Amazon has also announced that it will be sourcing their European products directly from brand owners as well as manufacturers, instead of going through the middleman, which in their case is the distributors. So because Europe is Amazon's second largest market, and we think that by doing this, it's going to contribute to a margin boost quite meaningfully. And if we couple this with the emphasis on efficiency and the cost-cutting measures, we think that we can expect a margin expansion moving forward. For the second point is that Amazon is expanding its AWS customer base. So all companies across various industries are trying their best to cut down on their operating expenses. And one of the best solutions of doing so is to migrate their computing needs from on-premise data centers onto cloud computing. So because of this trend, we think AWS being the leader will definitely be one of the key beneficiaries. And AWS and Amazon has actually indicated that the new customer pipeline for AWS remains strong, and that it is actually in talks with many other different companies that has not become the customer yet, with regards to the plans of migrating to the cloud, and that they have said that they are committing to AWS for the long term. So yeah, the expansion of AWS customer base will definitely benefit Amazon because it's much higher margin business as well. And also it will bring recurring nature revenue for the company too. However, in terms of the near-term headwind, we still think that Amazon's revenue growth is going to slow down in the near term, and this is mainly because of two reasons. Firstly, is that consumers are still hammered with high inflation, which means that they are going to be more careful with their discretionary spending. And then secondly, like even AWS growth is expected to decelerate. And Amazon has stated that for the first quarter of 2023, the AWS growth is going to be in the mid-teen percentage. This is down from the 20% that they experienced in the fourth quarter of 2022. Yeah, so however, we still think that Amazon revenue is going to re-accelerate in FY22, particularly for AWS, because as I mentioned, AWS has expanded its customer base, and then therefore, which means that in FY24, there's a high chance that the customer, both new and existing customers, are going to opt for a more premium product when they need to scale up their computing needs, and especially when the macroeconomic environment improves. So yeah, that's for Amazon. Now move on to NVIDIA. So yeah, we have recently initiated our coverage on NVIDIA with the title AI is the Future. So yeah, for the key investment thesis for NVIDIA is that firstly, NVIDIA is the market, possesses a market leadership, as it has an 88% or 95% market share in the PC and data center discrete GPU market. So the market leadership comes because the company possesses a superior product performance, because its GPUs are powering about 70% of the world's top 500 supercomputers, which by itself demonstrates how powerful the GPUs are. And at the same time they have a high levels of energy efficiency, and then furthermore, NVIDIA was also the one who developed the programming language called CUDA, which was the first language that allowed the developers to code directly onto the GPU, and this is widely adopted by developers worldwide. And not surprisingly, CUDA only runs on NVIDIA GPUs. And it being widely adopted by developers means that they are practically locked into the company's platform. So this acts as a strong moat for the company as well. Then for the second highlight is that NVIDIA's data center business has been experiencing a strong growth momentum, and we expect this growth trajectory to continue moving forward as well. The data center revenue has quintupled within 3 years, from $3 billion in FY20 to $15 billion in FY23. And we think that this is going to continue because there's increasing demand of AI in data centers, as companies are trying to integrate AI into their respective operations. So as Jonathan mentioned just now, NVIDIA is inevitably will be one of the beneficiary of the generative AI boom. So the versatility and the capability of generative AI, which was proven by ChatGPT, we think that this could be a tailwind for NVIDIA as well, because it really coincides with the launch of its next generation data center GPU and CPU, which are designed and equipped with the necessary hardware to handle these type of large language models and complex and advanced AI models such as ChatGPT. Yeah, however, there's a risk that we think is quite important for NVIDIA, which is the fact that there's an increasing tension between US and China. So as you may be aware, one of NVIDIA's data center product has fallen into the list of the semiconductors that are banned from being exported to China. So NVIDIA is quite heavily exposed to the Chinese market, as well as the market makes up about 20% of NVIDIA's FY23 total revenue. So we think that if the geopolitical tension between the two countries continues to escalate, there's a great degree of uncertainty whether NVIDIA is able to continue selling its products to the Chinese customers. So yeah, that's all from me. Now I'd like to hand over my turn to Ambrish to talk about Microsoft. Thank you.
Thank you, Max. So moving on to Microsoft. There are two key drivers we believe for Microsoft. First of all, its cloud service, Azure, as well as its productivity software, Office 365. So productivity as well as its cloud segment, it contributes almost 75% of its overall total revenues. So moving on to our thesis, Azure cloud momentum is still strong. So Azure, it has a market share of, it is the second largest cloud provider behind Amazon, and it has a market share of about 22%, and it has doubled its share from 10% over the last 4 to 5 years. So we believe that Microsoft Azure, it will continue to gain market share, mainly because company it claims that it has a pricing power over Amazon Web Services, as well as Azure's integration capabilities with Office 365, and as companies that digitize their operations. So overall, the growth in Azure segment, it will also help improve Microsoft's profitability, and mainly because cloud sales, they are high margin business as compared to the other business segments. So for the third quarter of 2023, Microsoft, it expects its Azure revenues to grow up by about 30% year on year. Moving on to our second thesis, demand for Office 365 remains resilient. So Microsoft, it has a market share of about 90% in the overall productivity market software, which includes its Teams software. Recently, Microsoft, it said that Teams, it has its monthly active users are about like 280 million, as compared to Slack, I think it has 20 million. So the main key drivers for this segment are that as the economic reopens and the rising need to manage works and task force, these are the key drivers for this segment. So as the offices reopen and as employees, they start going to offices, we believe that the more number of users would use Office 365 platform to manage their tasks. And in terms of negatives for Microsoft, we believe that weak personal demand, weak PC sales, it has a weak demand, and it would hurt Windows OEM revenue for Microsoft. So Windows OEM revenue, it's basically the revenue which it generates from the PC manufacturers like Dell and HP, who install Windows software on their machines. So overall, we still we have a buy recommendation on Microsoft, and we have a target price of $298. Next slide, please. So moving on to Airbnb, we believe that travel demand should continue to be strong going forward in FY23. So Airbnb, it's basically an online platform. It's an online platform and for homestays and unique experiences. So moving on to our thesis, it's witnessing higher booking volumes. So last year in FY22, Airbnb, it already surpassed its pre-pandemic bookings volumes, and we expect the volumes to grow by almost about 2% over the next 2 years. And this is mainly because of recovery in cross-border and urban travel as the COVID-19 restrictions, they have eased. And also the long-term stays of over 28 days, they have remained resilient on the platform, mainly because of the flexibility of the remote work environment. Also, Airbnb, it recorded a unique, it recorded its highest unique supply base of almost 6 million as of December. And it has also consistently introducing new initiatives, new product innovations on its platform, like a flexible search, flexible dates for the travelers, as well as several other features like Ask a Superhost and also insurance facilities. So these should benefit its top line. And moving on to our second thesis, a business is getting more profitable. So in FY22, Airbnb, it reported its maiden net profit of about 2 billion. And we expect its profitability to increase mainly because with this rising top line sales growth as well as high operating leverage. In terms of negatives for Airbnb, it's declining pressure on its average daily rates. And this is mainly because business mix shift towards the areas which have lower daily rates, like Asia Pacific regions. They have lower rates as compared to the US rates. Also, since Airbnb, it's a discretionary spending with high inflation and rising interest rate, it could impact travelers' budget, and it could negatively impact the lower booking volumes on its platform. However, in the long term, we believe that Airbnb, it is well positioned to benefit from the rising demand for alternative accommodations, as it is more homely and safe as compared to hotels. And also, it has a unique supply base and continued travel demand. So overall, we have accumulated a recommendation on Airbnb with a target price of $149. Next slide, please. So moving on to my third stock pick, which is PayPal. It's basically a digital payments company, and it has a global presence in 200 countries. So the main advantage for PayPal is that it benefits from two-sided network effects. This is mainly because PayPal, it serves both customers as well as merchants, and it has a user base of 400 customers as well as 35 million merchants. So customers, they can transfer money to their family and friends on the PayPal platform, as well as they can pay for any goods that they have purchased. Also, for merchants, they can create a business profile and they can receive payments for the goods that have been sold by them. So moving on to our thesis for PayPal, it's witnessing customer engagement, it's climbing. So if you look at the chart on the left-hand side, the number of payment transactions per user, it has increased from about 40 in FY20 to almost nearly 50 or around 54 in FY23. And this is important mainly because company, it's now shifting its focus from adding new customers to user engagement. So, I mean, so they don't need to spend any additional dollars to attract new users. So rather they would now focusing on attracting on user engagement. And the one thing that they are right now trying to monetize, it's a Venmo platform. So Venmo, it's also a digital wallet platform which it owns. So recently it has been added as a payment option on Amazon. So as the e-commerce growth they surge, and as the Venmo adoption increases, it might increase the payment volume for PayPal. So moving on to the second thesis, PayPal, it's focused on improving profitability. So last year in second half of 2022, PayPal it cut its cost by almost $900 million, and in FY23 it's planning to cut its expenses by about 1.9 billion, and it plans to improve its operating margin to about 23%, which is like a 125 basis point year on year. And this is mainly driven by the layoffs that have been recently announced and the real estate consolidation. So in terms of negatives for PayPal, the total payment volume on its platform, it has reduced significantly if we compare with the growth rate in FY21 and FY20. It increased by 33%. However, in FY22, it surged by 10%, and this is mainly because of weak e-commerce trends as well as the macroeconomic uncertainties, as the consumer spendings they declined due to the inflationary pressures. However, for PayPal, we believe that it's well positioned as it will benefit from the secular shift to the cashless payments, as well as its network effects, and also its monetization impacts from Venmo, which it should, as the e-commerce trends they improve, it should help drive its total payment volume through Venmo. So that's all for PayPal. I would now like to pass on to Zane for technical analysis.
Thanks, Ambrish. So I'll now move on to the technical analysis portion, where I'll give an outlook of the NASDAQ as well as the S&P for the upcoming quarter. Next slide, please. Next slide. Okay, so for the S&P 500, what we actually seen this quarter is a successful retest of the downtrend breakout. So over here, in the chart, we can see we have this key downtrend resistance line that has acted as a key resistance for the whole of last year. And early this year, we had a breakout that took place, and they reached about close to the 4,200 level before we had a retracement to backtest this breakout. Upon the backtest, we see that it was supported and we started to rebound again. So looks like it's some bullish signals for now. However, something to take note is that the 4,100 to about 4,200 level remains a key resistance for now. And the higher end of resistance would likely be at 4,003 if we have a breakout above the 4,002 level. For now, we are likely to see some form of resistance as we are near the retest of this uptrend support line that was being broken down. Yeah. And then we could be seeing a bit of a backtest of the descending broadening wedge pattern that we broke out of as well. So with that, we could see the S&P trade in about 3,009 to 4,200 range for this quarter, with 3,009 being the support levels of the two recent swing lows generated this year. Next slide, please. Okay, so for the NASDAQ, next slide. Okay, so for the NASDAQ, it was bullish this first quarter of this year as well. We saw a breakout over the downtrend resistance line shown in the chart, as well as a breakout of the bullish broadening descending wedge pattern. So for now, it looks like we are currently near a retest of the recent swing high around the 12,300 level over there. For now, we are likely to see some form of resistance. So with that, we could be seeing a little bit of a pullback to possibly retest the 11,500 mark over there, which was a previous resistance level, as well as possibly a retest the breakout of this descending wedge. So with that, we could be seeing a little bit of a range-bound movement this upcoming quarter, with the zone being at around 11,400 to about 12,600, thereabout in this range. Yeah. So I think that's all from me for the technicals. I'll now pass on my time back to Jonathan to round up the session.
Thanks, Zane. Into the next slide, please. Yeah, so this is just I guess a run out of our PSR US stock coverage. Over here we've got the companies. I believe we've got 15 companies. Their tickers, their ratings. A lot of accumulates, some buys. Our target price, which is usually a 1-year target price, so 12 months from the date of issuance, and the last close price. Next slide, please. Basically, in conclusion of this event, just to run out some points, we think inflation is going to continue to trend down. We do expect it to fall a little bit quicker than what has been happening, which actually hasn't really been that great. If you think about how far we've come from the peak. Obviously, our second point, we do expect interest rates to be close to peaking. Like the market, we do expect about one more rate hike till we reach about the 5% level, and then for the Fed to kind of hold it there, which is essentially what they've also said. They don't expect any rate cuts in their base case for 2023. We do think it's still a very challenging environment for growth stocks, for tech stocks in general. High interest rates are still a headwind. Firstly, just on valuations, and secondly, borrowing is a little bit more expensive. We do think that also, as a growth stock, it's difficult to, I guess, call yourself a growth stock when you're growing like in the mid-single digits, 5-6%. It's a far cry from what they used to be at 20, 25, 30%. And yeah, so mainly because of this, do you think that for right now, it's still very uncertain about how these growth stocks will perform. And our last point, we do think that the recession may be a little bit deeper than expected. Actually, right now the market's pricing in a soft landing. Don't think that we don't think it'll be a hard landing, but we do think that it'll be somewhere in between. When you look at the past recessions, they've kind of gone down from a range of about 25% to about 50%. So we do think that from peak to trough that there is still a little bit of room to go down. But for right now, the market does expect a soft landing, and this is mainly because they expect the Fed to start cutting rates quite significantly for the rest of the year. So with that, we'll end off today's session. I think, or rather, I guess we'll move into Q&A.